Hello everyone. Have you ever thought about investing in Indian share market but stopped because it felt too risky or confusing? You are not alone. Many of us grow up hearing stories about quick money and big losses, which makes the stock market sounds like a casino. But what if I told you that most of what you have heard is a myth? In this video, I am going to bust the three biggest myths of the Indian share market and show you how to separate fact from fiction so you can start your investment journey with confidence. Let's get started. So, the first myth is the share market is a form of gambling. This is the most enduring myth. People equate the stock market with betting, believing that it is an unpredictable game of chance where one's financial well being is left to luck. It is a perception that holds many people back from investing. While both the stock market and gambling involve risk and the potential to lose money, they are fundamentally very different. Let's try to understand the key difference that show why investing is not the same as gambling. Number one is ownership versus zero sum game. When you buy a stock, you are buying a small ownership stake in a company. You become a shareholder as the company grows, become more profitable and increase in value, so does your share of the company. It is a positive sum game where many people can benefit as a company succeeds. Gambling, on the other hand, is a zero sum game. For you to win, someone else must lose. The casino or bookmaker always has a mathematical edge, that is the house edge, which guarantees them a profit over the long run. You do not get any ownership or a stake in the casino success by placing a bet. Next is research and analysis versus luck. Successful investing is based on research, analysis, and strategy. Investors study a company's financial statements, management team, industry trends, and economic outlook. They make informed decisions to assess the intrinsic value of a company and its potential for future growth. On the other hand, gambling, the outcome is largely determined by chance and luck. While some games like poker have elements of skill, the vast majority of gambling activities like slot machines and roulette rely on pure randomness. Next is long term wealth creation versus short term gains. The goal of investing is to build wealth over the long term. This is done through strategies like buy and hold, where investors patiently wait for their assets to appreciate over years and sometimes even more. Over the long run, the stock market has historically provided positive returns averaging around 10% annually. Gambling, on the other hand, is about immediate gratification and quick win or a loss. It is a short term activity with no long term wealth building potential. And finally, the risk management. Investors have multiple tools to manage and mitigate risk. They can diversify their portfolio across different companies and sectors, invest in index funds to spread risk, or use strategies like stop loss orders to limit potential losses. With gambling, your options for managing risk are very limited. Once you place a bet, your money is at stake and you have little to no control over the outcome. If you lose the entire amount wagered. So, while day trading and high frequency trading can be seen as speculative, long term fundamental based investing is not. The market rewards patience and research. The Nifty 50, a benchmark index for Indian stock market, has demonstrated an average annualized return of around 11 to 12% over the long term, including dividends. This consistent growth over decades, despite major global crises like 2008 financial crash and COVID-19 pandemic, is a testament to wealth creation, not gambling. A systematic investment plan, that is SIP, of 10,000 rupees per month in Nifty 50 index for 10 years has historically generated a total corpus that is more than double the invested amount. This is a result of compounding and rupee cost averaging, not luck. So the verdict is that this myth is busted. Let's move on to the next myth. So the Next myth is you can get rich quick through trading. Now, this is a heavily fueled by social media influencers who showcase their daily profits from trading, creating an illusion of effortless wealth. While the allure of fast money is strong, the reality of building wealth through the market is very different. Let's see the key differences between a get rich quick approach and a sustainable investment strategy. First is the time horizon, short term versus long term. Get rich quick mentality is the approach which focuses on short term gains and often involves day trading, scalping, or futures and options. The goal is to profit from small price movements in a matter of minutes or hours. This requires constant attention, and each trade is a high stake bet. Sustainable wealth building is the approach which is centered on a long term horizon of several years or even more. The focus is on a company's fundamental growth and value over time. Short term market fluctuations are considered normal noise, not a reason to panic. Next is strategy and mindset, speculation versus investing. Get rich quick mentality is a mindset of speculation and impulsiveness. It often involves chasing trends, acting on unverified tips, and attempting to time the market perfectly. This approach is highly emotional and can lead to irrational decisions. Sustainable wealth building is a mindset of discipline and research. It involves analyzing a company's financials, understanding its business model, and assessing its long term potential. This strategy is based on sound data and a clear plan, not on gut feelings or market hype. And the third is risk, high risk versus managed risk. Get rich quick mentality carries extremely high risk. The very nature of short term trading means you can incur significant losses very quickly. The use of leverage, that is, borrowing money to amplify returns, can wipe out an entire account in a single bad trade. The odds of consistently beating professional traders and algorithms are very low. Sustainable wealth building focuses on managing and mitigating risk, a core principle in diversification across different stocks, sectors, and asset classes to protect the portfolio from a single poor performing stock. The power of compounding returns over time, combined with consistent investment, that is SIP, allows for gradual and exponential growth. So, the reality is that stories of someone getting rich quick are often the exception, not the rule. The vast majority of these attempts end in financial losses. The true power of the Indian stock market lies in its ability to create sustainable wealth for those who are patient, disciplined, and focus on long term growth. A study by the SEBI on the profitability of individual traders in the futures and options segment from financial year 22 to 24 revealed a stark reality. Over 90% of individual traders incurred losses. The collective losses of these traders were staggering, exceeding 1.8 lakh crore rupees during that 3 year period. The SEBI study also found that a significant portion of these loss making traders were young, under 30, and had a low annual income of less than 5 lakh rupees. This data strongly suggests that the allure of quick money often leads to significant financial losses for those who can least afford them. So the verdict for this myth is it is busted. Let's now move on to the third and final myth for this video. The third myth is buying a low priced stock is always a good deal. This is the classic penny stock fallacy. Investors believe that a stock trading at 5 rupees or 10 rupees is cheap and has a high potential for multi-bagger returns, while a stock trading at rupees 5000 is expensive. Let's see the key difference between a cheap stock and a cheap deal. The cheap stock mindset versus fundamental analysis. The cheap stock mindset is the belief that because you can buy more shares of 5 rupees stock than a 5000 rupees stock with the same amount of money, The low priced stock is a better investment. This mindset often ignores the underlying business and focuses solely on the absolute price per share, leading to a focus on quantity over quality. On the other hand, fundamental analysis is the process of evaluating a stock's intrinsic value by examining its financials, management, and industry. The goal is to determine if the stock's market price is higher or lower than its real value. An investor using this approach looks for a cheap deal, not a cheap stock. Next is the valuation versus price. The price of a stock is a function of its market capitalization, that is, price per share into total number of shares. A company with a market cap of 10,000 crore rupees and 10 lakh shares would have a share price of 10,000 rupees. A company with the same market cap but 100 crore shares would have a share price of only 100 rupees. Both are valued equally by the market. The low price is merely a result of the number of shares issued, not value for money. And the third is risk of a value trap. Investors who buy a low priced stock purely on the hope that it will rise may be falling into a value trap. A value trap is a stock that appears to be a good value because it has low valuation metrics, but is but it never recovers because the business fundamentals are deteriorating. This can lead to a stock price falling further, or worse, the company being delisted or going bankrupt. So the price per share is irrelevant without considering the company's valuation metrics and fundamentals. A company's true value is reflected in metrics like P ratio, PB ratio, debt to equity ratio, and others. A low priced stock can have a very high PE ratio, indicating that it is a fundamentally overvalued. Indian market has a large number of what are known as penny stocks. The price of a stock is just a number. It does not by itself tell you anything about the company's value or future potential. So the verdict for this myth is as well is busted. So there you have it. The share market is not a magical place for getting rich quick, and it is certainly not a form of gambling. The real magic lies in patience, discipline, and consistent investing. By letting go of these myths and embracing a long term research based approach, you are not just trading stocks, you are participating in the growth story of India. Now, the power to build your financial future is in your hands. Thanks for watching this video. Please like, share, comment, and subscribe. Goodbye for now and happy investing.